Hey, in this video, I'm going over 10 of my favorite stocks to buy right now. It doesn't matter if you want to invest $100, $1,000, or even $100,000 or more. These 10 companies are my picks based on their potential growth and their financials. So with coronavirus ravaging the US economy and sending stocks on a free fall dive the last month, this has presented a unique buying opportunity for many investors. Let's take a look at VIX, which is basically the market's expectation of volatility for the next 30 days. Over the last month, it has completely exploded in growth. For example, the price was $13.68 on February 14th. If you fast forward just 1 month to March 16th, you can see that the price of VIX has grown to $82.69. Since then, it has been dropping, which means that volatility is going down. That's probably a good thing for most stock buyers because volatility is very dangerous. However, let's take a look at the stock market as well. On February 19th, 2020, the S&P 500 was at 3,386. Fast forward about a month to March 23rd, and the S&P 500 was at just 2,237. That is a drop of 34%, which is just insane. Since then, it's back up to about 2,600 as of April 6th, 2020. And if you compare that to the all-time highs, that's about a 23% decrease. So much less than 34%, but also not an insignificant drop. Let me get this straight, you guys. So it's just impossible for us to time the bottom of the market. No one knows when that's going to happen, what price that's going to be at. And also, we don't know if we've already reached the bottom. Like, we don't know if it's going to continue going down, if it's going to plateau at this level right now, or if it's just going to start going back up. Or it can start going back up and then drop back down. Who knows? Right now, it's all speculation. And if anyone tells you that they know how to time the bottom of the market, it's likely that they are lying. The market is just like too dependent on many things that are out of our control and also out of our knowledge. It's hugely emotion-based. And there's no way we know how all the other investors in the world are thinking right now. It also doesn't correlate exactly with the economy. You know, in the past month, we've seen huge unemployment numbers. And on the same day that those numbers are released, we've seen increases in the stock market. So lots of things are priced in already, and we just don't know what those things are. So I say this because there's a group of people that are like, don't buy. Now is not the time, it's gonna keep going down. The economy is nowhere near at the lowest, and we're gonna see significantly more drops. But then there's also another group that's like, guys, buy now. Everything is on sale. The economy is gonna recover, and in the long term, now is a great buying opportunity. So in terms of where I stand, I'm more in the second group, but I'm not fully there. What I mean by this is I'm not going to be spending all of my money, all my free cash on stocks right now. Instead, I'm going to be dollar cost averaging and buying as the market drops. So sure, it definitely could go further down. I wouldn't be surprised if it did. And if it does, I'll just keep buying more. How I like to view it is, in the grand scheme of things, stocks are on sale right now. And if you zoom out to see the bigger picture, or if you fast forward like 20 years from now on, you're gonna see that these prices are a really great buying opportunity right now. Another thing is, if you look at the newspapers and articles written for all the other crashes in history, you'll see that they all have a similar sentiment. At the peak of the crisis, all the article headlines say something like, "We will never recover," or "the worst is yet to come." I mean, newspapers, articles, they need to have kind of like a sensational title to draw people in, but based on past history, the market has always recovered. Sure, right now it's a little bit different because this is a pandemic event. This is more like a medical event, which forces people to stay inside, and we've never really seen anything just like this, with unemployment soaring to unheard of numbers. But if history has a say, it says that it's going to recover. So I've done my research, and here are my top suggestions for companies that you should be looking at if you are looking to buy stocks right now. And these aren't in any particular order. The first one isn't the best one, the last one isn't the best one, and so on. So let's get into it. So first up is Disney. And we all know that Disney is getting royally screwed right now by coronavirus. All their parks are closed, which is a big hit on the revenue. They've also been giving out refunds to their annual pass holders, which means that that's another big hit in revenue. I think it's going to be at least months before people start trusting themselves to go into these amusement parks where there are lots of people in close contact with each other. But I am positive that it will happen. So yeah, all of Disney's parks are closed, but they still have Disney Plus, which is their streaming service. This is a big moneymaker and it has a lot of potential. If you look at the stock prices, you can see that in February, it actually hit $140 per share. But by mid-March, it had dropped all the way down to $79.07. Currently, it's trading at around $100 per share. I think this is a pretty great growth stock because there is a lot of potential for it to go up. It also is a mild dividend stock with its dividend yield currently at 1.87%. If you look at the 5-year chart, you can see that it's currently trading at the same prices as it was trading in 2016. That's almost 5 years ago. So yeah, in my mind, it's undervalued. Disney is a huge company and they have a lot of growth potential in the future. So now might be a good time to pick up some stocks. So next up on my list is the company 3M. And this is the company that is making all the protective masks that healthcare professionals need right now. They are based in America. And if you look at the news articles recently, you can see that Trump was actually trying to get them to not export masks to other countries. That's how big the demand is for their masks in America. This stock is not necessarily a long-term growth stock, but it does have a relatively high dividend yield of 4.26%. And if you look at their data, their dividend has been increasing for the last 50 years. So I definitely don't think that they're going to be lowering their dividend anytime soon because their sales numbers are through the roof and there's no reason why they would have to cut their dividend. Unlike many other companies on this list, and in general, they might have to cut their dividends just because their revenue for 2020 is going to drastically lower. I think this is a great bet if you want a high-paying dividend stock, but also want to see some growth potential in the future. 3M is one of those companies which is actually going to do better in this economy than before. So as a result, it's also less volatile and there's a lower chance of you losing your money. It's also a great way to diversify your portfolio. If right now most of your stocks are just high growth, high risk stocks, then this is a good stock to add because it's just a little bit safer, especially in a time like this. Next up on my list is Coca-Cola, and everyone knows this brand. Coca-Cola is a manufacturer, retailer, and marketer of non-alcoholic beverage concentrates and syrups. They're obviously best known for their drink Coca-Cola, but they also have tons of other brands like Fanta, Sprite, Dasani, and a lot more. I do think that we are in a rare buying opportunity for Coca-Cola because their stock price has dropped significantly since the start of coronavirus. In February, their stock price actually reached $60. But then over the last month, it's dropped to a low of $36.27. And right now it's trading around the mid 40s. One great thing about Coca-Cola is that it has a pretty high dividend yield. Its current dividend yield is 3.74%. And we've seen its dividend grow every year for the last 57 years. Its price to earnings ratio is at 20.95. Like 3M, the stock I previously mentioned, this is a great stock to hold if you want something that's a little bit safer and with a lot of growth opportunity as well. I mean, man, this stock is down 25% since its all-time high just a month ago. They are not going anywhere, and that's why I think Coca-Cola is a great buy right now. We've seen them on an upward trend for the last 5 years, and I don't think that's going to change much. Number 4 on my list is Tesla. And Tesla was one of those stocks that just exploded at the start of the year, with many saying that it looked just like Bitcoin in 2017. You guys remember that, right? We saw their stock trading price going from around $200 to $300 to a high of $968.99 on February 4th, 2020. Since then, they've fallen more to around the mid 500s, and they're currently trading at $516.24 today. This huge fall, like many other companies, is due to COVID-19 and also a drop in consumer spending and layoffs as they had to close their Fremont factory. Right now, they do have about $8 billion in cash reserves, which means that they have at least 2 quarters or so of zero car sales until they start to get to a territory that's a little bit dangerous. Right now, its factory in Shanghai and its battery production factory in Nevada are still open for production. I actually hold a lot of Tesla stock, and I have a lot of friends that have a lot of Tesla stock as well. The reason why we have so much of Tesla stock is because in the long term, we think that Tesla is going to be one of those companies that just, changes the whole game. They already have, but there's a lot more potential where it's from. They are far more than just an automaker. They have tons of other industries where they're disrupting the entire industry, such as autonomous driving, battery technology, and solar. So, I mean, I think that the rise to like almost $1,000 was a bit much, as that was just one of the hot stocks that everyone didn't want to miss out on, which kind of pushed the price that high. And now it's trading a little bit more for where it's actually worth. But in the long term, I think Tesla has the opportunity to go to $1, $2, or even $3,000 per share. That's why I continue to buy Tesla, even if it drops in price. I know that in the long term, it doesn't matter if I buy a share at $600 or $400, because when it gets to its future valuation, then I'm going to have a lot of profit. Number 5 is Apple. And I think this is probably the one company that everyone in the world knows. They currently have $99 billion in cash reserves, which for a time like this is much needed. Now, before coronavirus, they were popping off the charts. But with China being the first place affected by coronavirus, they were obviously affected when they had to shut down their factories in China. Now, with China getting back to normal right now and the factories opening back up, I think one of the biggest hits that they endured has been lifted. In addition, rising demand and reliance on mobile phones will continue this demand for the iPhone and also the App Store, which makes up a huge portion of Apple's revenue. Overall, I think I'm just a long-term believer in Apple as a company. I think they're a very innovative company with tons of growth potential in the future. If we look at the stock chart, you can see that on February 12th, they actually hit $327 per share. Right now, they are in the mid 200s. That's a lot of drop for a behemoth like Apple. And I think a lot of this drop was due to investors just being scared of the volatile markets and offloading all their stocks. If there's one thing people can't live without, that's their iPhone. So I think that although consumer spending will decrease for 2020, I think iPhones are pretty much an essential piece of technology that everyone needs. Yeah, so overall, Apple is one of those companies that isn't going anywhere. They're going to be huge for the next 30 years at least. So that's why I recommend picking up some of Apple's stock. Next up is Berkshire Hathaway, the company that is owned by Warren Buffett, probably the most famous investor in the world. He's built a reputation of succeeding with his investments and, of course, being one of the best investors ever to live. Now, recently, this pandemic has hit his company pretty hard, as many of the stocks that they're invested in were not immune to the COVID-19 sell-off. If you look at their stock price earlier this year, you can see that it reached a high of $231.61, but it did reach a bottom of $159.50. And now it's sitting at around $185 per share. I'm talking about their B shares, by the way, not their A shares, which are like $200,000 per share. So right now, Warren Buffett's portfolio is around 40% cash. And this means that he has the ability to be greedy when other people are fearful. That's one of his famous quotes, and that's what's really made him very successful, I think. So now with this buying opportunity and his knowledge of the market, I think he can take all that money and turn it into a lot more. Basically, I just trust the guy. Now, recently he did sell off a ton of his Delta and Southwest stocks. And while he did take a huge loss on those stocks, I do think he knows what he's doing right now. His whole grasp of the market and how it reacts to certain economic stimuli is top class. Even if this is an unprecedented event and no one has experienced anything like this before, I think that if there's anyone that knows best, it's probably going to be someone like Warren Buffett. Crisis situations have proven to be quite lucrative for him in the past. And yeah, I just trust the guy. I trust his advice. I trust all the experience he has. And that's why I think right now is a good time to buy Berkshire Hathaway stocks while they're on sale. You know, why not have this genius investor represent you right now? And that's pretty much what you're getting when you buy Berkshire Hathaway stocks. Okay, next up on my list is VOO. And this is my favorite ETF of all time. This is Vanguard's S&P 500 index fund. And it's generally where I invest most of my money. If you look at their stock chart, you can see that on February 19th, they reached an all-time high of about $310 per share. Fast forward to April 6th, and now the current price is $240 per share, which constitutes a 22% drop. The reason why I like this stock is because it's a safe bet for the long-term market. This is the stock that I buy when I want something to grow for 30 years and I just don't really touch it at all. So for a Roth IRA or for any other retirement account, this is a great buy. VOO tracks the S&P 500 index and it's seen very great growth in the last 10 years since its inception. The reason why I invest in VOO is because its expense ratio is just so low at 0.03%. This basically means that you are pretty much paying nothing as a fee to hold this index fund. There's no other way that's as cheap as this to invest in the S&P 500 as a whole. And that's why I think it's a great long-term hold. The less money you pay as your expense ratio, the more your money grows, and of course, the less fees you're paying as well. And fees compound exponentially, and that's why it's so important to invest in something that has a low expense ratio, just like VOO. Buy the stock while it's on sale, you guys. You won't regret it. Okay, next up on my list is Bank of America, BAC. Now, banks have been hit pretty hard by coronavirus. Interest rates have plunged, and that also means that the margins at banks have plunged as well because a lot of their profit comes from lending. Also, with more and more unemployment, that means they're expecting more mortgage delinquencies, which will also hit them hard. If we look at Bank of America's stock price, you can see that their 52-week high was $35.72. In March, they hit a low of $17.95, and right now it's in the low 20s. This is still a huge decrease from its high of about $35, and this constitutes a 40% drop in their stock price. I think Bank of America is a solid company, and they also pay a pretty good dividend. Their current dividend yield at its current prices is 3.59%, and its price to earnings ratio is 8.22. Yeah, overall, Bank of America is one of the strongest banks in the US, and it's not going to fail. In the 2008 recession, Bank of America was actually better than all the other banks at reducing its balance sheet risk. I think that it can definitely drop more in the near future, but in the long term, it's a very good buy. In order to buy Bank of America, you need to believe that the economy is going to get back in the next year. I think it's massively discounted right now, but I do think that there is a lot of potential for it to go down a bit more in the near future. We'll just really have to see what all this unemployment does to mortgages and see how the lending industry goes. With a long-term vision in mind right now, this is a great buy. Okay, next up on my list is Carnival CCL. And obviously, as we've seen in the media, cruises have been hit so hard by coronavirus. We've seen their ships stranded at sea with no ports offering to let them dock, and this has created a lot of fear in the consumer's eyes as to whether or not cruising is still going to be a viable option for people to go on vacation in the future. Currently, Carnival is trading at around $10 per share. If you just rewind a couple months, you'll see that they reached actually a price of $50 per share, and this means that their price has gone down by 80%. Now, at their current pricing, their price to earnings is 1.97 and their dividend yield is 23.56% theoretically. But we've seen that Carnival has agreed to alleviate its liquidity pressure, and as a result, they've agreed to cut their dividends before the next payout. This makes a lot of sense because there's no way that they can pay 23% dividend yield based on their current and expected revenue for 2020 and even 2021. We've sort of seen a slowing of death rates and infection rates in some countries. But yes, it is still going up in certain other countries. If we look at countries like Italy and Spain, we can see that their numbers are slowly starting to go down. And in current news, Saudi Arabia's sovereign wealth fund actually just purchased an 8.2% stake in Carnival. That means that at least one investor thinks now is a good time to buy. With Carnival, we've seen violent price swings and we've seen the price of the stock just plummet. Right now, the price of Carnival is pricing in the sentiment that some investors think Carnival will not survive coronavirus. They think that the cruise industry is just screwed as a whole. But in my opinion, I think cruises are a great way for many people to vacation. And I don't think the cruise industry is going to be going bankrupt anytime soon. People are like, who in their right mind would go out there on a boat surrounded by people in a confined space and vacation that way? I think once you've gone on a cruise, you'll see that it's actually very great way to vacation. And just because of a pandemic event like this doesn't mean that all cruises are going to go out of business. Cruising, in my opinion, is always going to be a solid industry. Now let's look at the price of CCL for the last 10 years. And you'll see that right now, it's at the lowest it's been since 1995. That's 25 years ago. This is a longer term hold, and yeah, it is a little bit risky due to the risk of liquidation and bankruptcy. But if their sales and revenue goes back up once a vaccine is found for coronavirus, and I do think it will, I think this current price is an absolute steal. Whew, so those are my 10 stock picks, you guys. Now, regarding timing the bottom of the market, your chance of timing the market is also slim to none. People say to start buying stocks when a vaccine has been found, or when the infection rates really drop, or when the economy starts picking up. But the problem is that the market generally rebounds before the economy does. And we've seen in the last month just how disconnected the stock market is with actual economic news. It's just very, very hard to know exactly when to buy. And so that's why I practice a technique called dollar cost averaging, which is just buying stock continuously, even if it drops. This is a bit more risk averse than putting all your money into a stock at one single time. And it sort of protects you from any big drops in the short term that could happen. If you look at it in the long term, dollar cost averaging minimizes your risk, takes advantage of historical growth data, and also, but most importantly, takes out the emotion from buying and selling stocks. In the long term, these stocks will grow. We just need to buy stocks with the expectation that they might go up or down in the short term, but in the long term, they're going to grow and grow and grow. If you invest in good companies, the stock prices will grow and you will make money. So yeah, anyways, thanks you guys for watching. I hope you guys found this video helpful. These are just 10 of my recommendations for stocks that you should be checking out right now. A lot of these stocks are undervalued and a lot of them have tons of growth potential in the future. Some of these stocks are also good dividend stocks, and some of them are more on the risky side, but have tons and tons of growth potential. So it's really up to you which companies you want to invest in, and also how risk averse or how risky you want to get with your investing. As always, I encourage you guys to do your own research on these companies and make the choice yourself whether or not to invest in them. Always do your due diligence, as stock investing is something that you shouldn't just listen to other people and buy whatever they're saying to buy. If you guys found this video helpful, make sure to like this video and also click that subscribe button and turn on the bell notification so you can see when I upload videos. I appreciate all you guys so much, and thanks for watching. I'll see you in the next video. Peace.